and welcome to Big Market Debate. I have with me Mr. Ajay Bagga, independent market expert, and Mr. Jaiswal, technical analyst, manasjaiswal.com. Welcome to the webinar, sir. Ajay, my first question would be for you. COVID-19 second wave has hit us really very hard, and we surely are going to take some more time to get out of it. So what is the kind of impact that you see on the GDP numbers of our country? Would the impact be as harsh as it was in 2020?
No, Gitu, not as harsh as 2020 because companies were better prepared. Second, the governments were better prepared. But having said that, I think it will lead to about 2 months of a limited lockdown. That's our estimate right now. Our estimate is that the Maharashtra second wave peaks sometime around end of May. And the India second wave will peak around June end because as studies have shown, of the 16 countries in the world amongst the top 30 that have had second, third, fourth waves so far, the second wave normally is lasting about 4 months from the flattening of the first wave till the end of the second wave is about 4 months. Maharashtra has gone through about 120 days. So we have probably peaked at about 66,000 cases on a daily basis in Maharashtra. And then it started flattening. It will go down further. And by May end, I think Maharashtra should be leading us out of this. And rest of India is still growing. The 7-day average is still growing. So it will grow further, flatten around mid of June, and then start tapering off in end June. So we are looking at lost production in April and May in substantial regions. That would impact the GDP by about 2% for the whole year. There will be some catch-up as we come out of it in July as vaccinations take off. There will be a catch-up, but a lot of the service economy capacity will get lost. So 2% of GDP impact is what we are forecasting.
And what will be the impact on markets of the same?
Markets are looking ahead to June, July already. If you see, the markets did not react. Of course, on the last Friday of the week, we saw some sell-off, which started with the Chinese clampdown on their tech measures, and that became an Asian sell-off. Our markets reacted further. So I would say it was a combination of elections, China, and the COVID situation. COVID situation has got largely factored into the markets, and the markets have recalibrated. If you see from the February peaks, we are off substantially for quite a few sectors in the market. So the markets had factored this in, and now they are looking at June and July, when we should have something like a flattening and the economy seeing some more traction coming in. That's what the markets are now counting on.
Mr. Jaiswal, technically, where do you see Nifty going from these levels? I mean, we saw a good bounce back in the markets this week. 1,500 reclaimed by Nifty. Now what next?
See, looking at the
1,000 reclaimed for Nifty.
Yeah. See, looking at the charts, I can tell you one thing that Nifty has already made a bottom, the short-term bottom near 14,100, 14,200 mark. Yes, we have seen some correction in last 2 trading sessions, but I believe that the market undertone is now bullish, and the possibility is high that you may see a breakout above 15,000 mark after some more consolidation. But if it breaks 15K mark, then definitely you can see almost 1,000 to 1,200 points rally in Nifty. So I'm not bearish on this market, and I feel that Nifty will not go below 14,100. So this correction is a great buying opportunity, but again, I think you should always remember that this is a volatile market. So always you should keep the strict stop losses.
Mm-hmm. But can we expect a bit of more correction from the levels that we have come up to?
Yes, you can see almost 200 points correction, and Nifty can again test 14,400 mark, because I think this today is the first day of the correction. Nifty is trading just near to its 20-day moving average. So if it breaks 14,600, it can go down and test 14,400 also. But below 14,400, I'm not bearish on the market, and I feel that if Nifty touches 14,400, that would be a great buying opportunity. And again, you can see the levels of 15,000, 15,200 very soon.
Mr. Bagga, there has been a big shift by by FIIs and domestic mutual funds from large caps to mid cap and small caps. Do you buy this? I mean, everybody has been saying that this year belongs to mid caps and small caps. Are we right in saying so?
Well, the numbers, Gitu, show that even last year was the year of mid caps and small caps. They suffered in 2018-19. But last year, if you see, as against 70% for the leading markets, the broader markets gave 100 to 120%. So from the March 23rd bottom till now, small cap index would have given about 120% and the mid cap would have given 100%. So there is increased investment by FIs in small cap, mid caps, but it's not at the cost of the major stocks. So I think the more worrisome issue is that April will go down as a negative number after such a big number after last March and last September. Otherwise, nearly 6 months, we had very strong inflows from FIs. So is that a trend, or was that some recalibration happening, or was that lightening of positions looking at the COVID situation? That we will see in May. But that could become an issue if $1.5 billion goes out every month. Then we need a very substantial domestic supply to absorb it. So I would look at that very closely. Fundamentals are good. If the flows get challenged, that again then takes the market lower. So we'll have to wait and watch for that.
So what will your advice be, Mr. Bagga, to small investors who are invested heavily in mid cap and small cap space? Should one really, if they are in profits, book profits and move out for some time till this uncertainty is over?
Very difficult call. What we have seen over large periods of time, if you miss the top 40 days, 60 days, 100 days in the market on a 20-year basis, for example, you'll make negative returns. So nobody knew last year that, February mid would be the top, March 23rd would be the bottom. And hardly anybody got out in time for March 23rd. And then whoever got out in April, May, and then they never came back till September, October. So you missed a large part of the rally. So for most of the retail investors, I would say, if it's your equity allocation, you don't need the money, don't try to time. Nobody gets the timing right ever. But if you give your portfolio time in the market, it will benefit. So look at those cash flows, look at the management quality, look at the business model. And if you have seen all that, and invested in good quality companies, hold them through the cycle. We can never know when is the bottom, when is the top, when will markets turn. Only Manas can see that and tell us. But definitely in fundamentals, we can't see. So what we do is we stay invested across the cycle. Another thing I would like to share with the audience, Gitu, is there is 60, 70-year, 90-year research now that has been done across markets, nearly 66,000 companies across the world, across some 30 major markets. What it has shown is that 4% of the stocks are contributing to more than 100% of the market returns. Now, you can ask me, which are those 4% today? No one knows that. Even Warren Buffett will not know that. So best is to have a diversified portfolio for a very long term. Don't look at the Tokyo example, because that's what people say, that 1990 Nikkei peaked and after 30 years, it's not come to those levels. That's one outlier example. But largely, stocks will do better in the long term. And it's good to have a diversified portfolio spread out across sectors, and then just keep holding it. That's the best strategy for most retail investors.
Mr. Jaiswal, as you said that you are still bullish on the market with slight bit of corrections that you expect. 14,400 is the level that you're watching out for Nifty. If markets have to really perform, fundamentally, I'm saying that the banking sector has to perform. Now, what is Bank Nifty charts telling you? I mean, will they also hold up from the current levels? Because we have seen them coming around 30,000 levels and then bouncing back by a few points and recovering. But is this recovery really sustainable?
Gitu, just few days back, I think Bank Nifty broke its 100-day and 20-day moving average. And yes, it is not sustaining on higher levels near 34,000 mark, 34,200. But if you're talking about the trend, the undertone is, I believe that undertone is bullish because I see a lot of strength in stocks like IndusInd Bank. I see a lot of strength in stocks like ICICI Bank. Yes, HDFC Bank is looking weak on the chart right now. But again, if you're talking about the trend, the undertone of banking names, then definitely here you can see more returns from current levels. And I would like to go with ICICI Bank because here the trend is very clear. The stock is making higher tops and higher bottoms on the early chart. It is sitting above 20-day and 50-day moving average. And we have seen some correction, but this correction is a great buying opportunity. You can buy ICICI Bank at current levels, keep your stop loss below 570. And my target would be around 650, 660 for next month in ICICI Bank.
What about SBI? Do you like that on the charts too?
Yep. See, just few days back, State Bank of India took support near to 100-day moving average, near 100-day moving average, and we have seen some recovery from lower levels. But again, if you're talking about little bit long term, say around 6 to 8 months time, then definitely you can take a bet on State Bank of India because I'm very much bullish on State Bank of India for little bit long term, say around 8 to 10 months time, and I see the target of around 500 in State Bank of India. So this correction is a great buying opportunity for investment in State Bank of India. I'm not talking about trading for next 1 or 2 weeks time.
Okay, Mr. Bagga, what's your view on the financials? I mean, is credit now we're talking about asset quality concerns which are fading out, but is credit more over challenge and an overhang for banking companies now, banks now?
Yeah, globally, if you see the global banks management commentary, credit growth is not very strong. But overseas, what's happening is people are going directly to the corporate bond market and raising money. In India, only the AAA companies can really access that market. It's largely shut to the others. So what we are expecting is, the asset quality has not deteriorated as it was expected. So there are higher provisions on most balance sheets of NBFCs and banks as well. It's been a positive surprise. Second big thing is the credit growth. We are not expecting very strong for the next 6 months at least. This COVID second wave will have an impact. There will be a third wave 3 to 4 months from now. It's inevitable because vaccination will take time. So this next 4 to 6 months will be challenging in terms of credit growth, but banks are largely well provided. We have to stick to quality. We have to stay with the top 3 to 4 private banks and the top 2 public sector banks. Don't go below that. The turnaround time will come in 12 months' time. It's still early, and markets will start discounting that, say, 6 months, 8 months from now. If everything goes as per plan and we have the end of the second wave by mid-July, then 6 months down the line is probably your best chance to get into the smaller banks. Right now, stick to quality. Stay with the majors, the HDFC banks, ICICI banks, Axis, and SBI, what Manas was mentioning. These have a lot of drivers and they have excess provisions, very strong managements. They will do better, I feel, than the second-tier banks.
Mr. Jaiswal, what's your view on the IT space? I mean, they saw a very good run-up during last year. Now, a bit of consolidation seen in IT counters. Fundamentally, earnings have been very good. Numbers, they came out with very good numbers for any stock that you talk about, your TCS, Infosys, Wipro. How do charts look for all these frontliners first?
See, in I think in last 1 year, we have seen a tremendous rally in IT space, and I think the Nifty IT index rallied from the level of around 11,200 to almost 27,000 mark. But now I think you can see some meaningful correction, because on the weekly chart, that index has made a dark cloud curve pattern. Yes, index has some support near to 25,200. But looking at the pattern of the individual stocks, especially stocks like STL Tech and Infosys, I think you can see some meaningful correction in IT space. This index can correct almost 10 to 12% from current levels. But again, if you're talking about long term, I think on correction, you can definitely take a long call in stocks like Infosys and STL Tech. However, if you're talking about very short term, I think you should just avoid IT for some time.
Mr. Bagga, what's your view on the IT space? I mean, virtualization of businesses, digital is a buzzword these days. So would you be a buyer in IT on dips?
See, again, on a one-year basis, it's a huge outperformer. But if you take it on a slightly longer basis, then you see that, and if you look at the digital parts of most of these businesses, then you see a lot of growth embedded. Not comparable, but you look at the results of the FANG stocks. Amazon gave a 44% year-on-year growth. Look at Google, look at Microsoft, Apple. Only Netflix gave a 28% year-on-year revenue growth. So not comparable. These are product companies, service companies, but they are getting into digital, and there is a lot of growth embedded there. So I would say maybe short term they might not perform, but they are a global play. In India, you don't have that strong product exporters that you can buy. So service exports you can get in. So it's a play on the global economic recovery, which is very strong. Second, the growth because of the digitalization. And third, the business model changes that are happening, and very cash-rich companies, they will keep on doing share buybacks and throwing out a lot of cash. As we have seen, a little tweak in the model like the new Wipro management did, and it was a huge re-rating of the stock. Those are the kind of potentials that are embedded. So I would be positive on our IT companies, and here even the mid-tier IT companies, because they would be acquisition candidates. The third part is the shared economy. All the Zomatos and all. We have seen the gamification plays like Nazara coming in, the suppliers like Happiest, Route Mobile, and all. So there is a lot going on. In this space overall in the digital economy, we should be very agile in getting into these. They are still on the ground floor. You will get a lot of returns in these stocks, even though the valuations are high, but the growth is as high. And frankly, I think this is more like 99. It is not 2000 March, so we might have a 2-year runway still for stocks to run up because of the global liquidity. It is akin to the roaring 20s, what happened after the Spanish flu with all the stimulus in the 1920s. The global economy took off for nearly 4 to 5 years. I think we might be at the cusp of that. So if that 2 years becomes 5 years, it might be good to get in now, or take small stakes every month for the next 6 months and build a position, so that even if there is weakness in the short term, you are getting into the high growth stocks.
Mr. Jaiswal, are there any interesting pockets for long-term investment in FMCG space?
See, if you talk about FMCG, for very short term, I am a little bit bearish on FMCG because I see some weakness in stocks like Britannia. I see some weakness in stocks like ITC. So I don't want to buy FMCG at current levels. I would like to wait for some time, some meaningful correction. On correction, definitely I would like to go with Hindustan Unilever, because if you see the long-term chart, I still believe that Hindustan Unilever can come in the range of 3,000 to 3,200 in next 12 to 15 months time. But I would like to enter in the stock on correction near around 2,200 mark or maybe 2,150. On correction, definitely one can accumulate Hindustan Unilever, but not at current levels.
Mr. Bagga, what's your view on ITC? I mean, it seems to be in love with 200, 210 levels. I mean, it's not not going off that. But now we're hearing a new some kind of a management insight like a demerger would happen, and then it's a good dividend payout company. So would you be a buyer in ITC at current levels if you were a long-term investor?
Yeah, overall, what's good for ITC, very stable business, though, at risk globally because of the anti-tobacco moves. But they have been diversifying over the years. They have a very good cash flow. The unfortunate part is that it has been a confused strategy for a number of years. So the stock has tended to underperform. But if you look at ITC right from the FERA days of 1973 onwards, I have an uncle who had stocks from them from that time, and those would be very small amounts of stocks will be worth multiple millions now. And I had personally picked up in the mid 90s, and today I get more dividend than my landed cost, thanks to the bonuses and the split that happened. So for a long-term investor, I would still say there is a lot of game in ITC. The problem is a lot of institutional investors might not be allowed by their mandates to be investing in tobacco, all the ESG and all those things coming in. That's why also the management might be forced to merge its other businesses, which will be value accretive. But it's not a run-to stock. It's for very long-term investors. If you like a dividend play and a very good play on India, it's available. Otherwise, there are enough FMCG plays. It is a very high valuation game in especially the MNC, FMCG, because of the clarity that you get, the kind of return on equity that they give, and the great cash that they keep on throwing out. So you have to pay a very high valuation for that. It's been traditional for 20, 30 years. I've seen people always say FMCG is overvalued, but it keeps performing. That premium for quality comes through. So short answer is it can be looked at. There are better plays. A better point might be if the demerger really fructifies, then you can go ahead and buy the FMCG part of it. That might be better.
Mr. Jaiswal, anything you like in pharma space? Because we have seen a good run up in all these stocks, be it the frontliners or the mid caps and small caps.
See, Gitu, many pharma stocks are looking very strong on the chart. So I think if you want to create a long-term bet, say around for next 6 to 8 months time, then definitely you can look at Cadla, because Cadla has broken its 2017 high of 550. It is sustaining above that levels. Yes, we have seen some consolidation, but again, looking at the pattern today, I feel that the consolidation phase is over, and I think the rally will resume soon. So if you're talking about next 6 months time, I have a target of around 700, 710 in Cadla. So you can accumulate the stock at current levels, keep your stop loss below 500, but target would be in the range of 700 to 710.
Anything you like in pharma space, Mr. Bagga?
Yeah, lots of Manas mentioned, and the technicals are actually reflecting because there is an embedded optionality in Cadila, in Dr. Reddy, with the vaccine rollouts, and in the listed space, you have seen the way Panacea ran up based on the Sputnik thing, or the way Dr. Reddy went up so strongly, and now it's plateauing. But there is a lot of optionality embedded in these. It's a play on the global, global generics. There is a play on the vaccination rollout, and vaccines are going to cost about $175 billion over the next 2 years, because there will be booster doses. It's not that it will end. And for a country of India's size, it's going to be never ending. It's like, we give polio drops to about 1.5 crore children every year. That's the kind of, now you are talking about 60, 70 crore booster shots for COVID every year. It won't be one player, it will be 10 to 12 players which will benefit. A few are in the unlisted space. Grab the listed space while you can.
Mhm. Mr. Jaiswal, anything that attracts you as far as the charts are concerned in the capital goods space? Because L&T saw a good move, your ABB, Siemens, all these capital goods companies have been doing very well. So anything you're liking on the charts and you would recommend investors getting into at current levels?
Yeah, I think in capital goods you can definitely look at Siemens because Siemens gave a breakout just few weeks back above 1700 mark, and the target of that breakout comes near 2050 mark. So even from current levels, you can see almost 200 to 200 points rally in Siemens. So definitely here you can take a long call with the stop loss of 1700.
Mhm. Mr. Bagga, is it the right time to get into infra space? Because government has been, pushing investment into spending into infra sector, and we saw a very good momentum in the related sectors also, like your cement, your metals, your steel. So, is it the right time to get into select fundamentally strong infra companies?
Yeah, so the suppliers into infra, it's a no-brainer. Get into cement, get into metals. Metals still, there is a lot of space. It will continue to rally because a commodity super cycle has started, and that normally lasts for a decade or more. It's not going to end very fast. Plus, with China getting very focused on pollution, global scale is reducing, and India will be a big beneficiary. So these players will have export potential also. Cement, despite a slowdown, overall the sector saw volume growth. They have taken out a lot of cost out. So the suppliers into this sector will do. The infra providers themselves, over last year, just to survive, the companies that have come out well, they are more deleveraged, they are more careful on their capital, they're looking closely at the government models, and the government also is rejigging the models so that companies are able to survive. There have been cases where companies had been run into the ground and they have come up very well. That is difficult for a retail investor. I would say stick with the top 3, 4 industrial companies, MNC or Indian. The capital, uh, the capex cycle, capital expenditure cycle is going to restart after nearly 10 years. We peaked sometime in 2008-9 was the last big cycle, 2003 to 8-9. Now we have had 10-11 years of deleveraging. And as growth returns by end of this year, early next year, the private capex will take off and markets will front end that by 2 to 3 months. So I would say another 6 months down the line, you might see the cyclicals, the infras turning around very fast. So it might be a good idea to start nibbling at it and allocate over the next 2, 3 months.
Mr. Jaiswal, what's your view on Tata Steel, SAIL, JSW Steel? I mean, very brilliant run up on the charts.
Yeah, I totally agree with Mr. Bagga for metal and cement. Even at current levels, you can see a lot of strength in some metal names, especially Tata Steel. Yes, we have seen some correction. We have already seen a big rally in Tata Steel, but even at current levels, if you have some time, if you have say around 3 to 4 months time, then definitely you can set the target of around 515 Tata Steel. So you can start accumulating Tata Steel at current levels. I think Tata Steel has. Sorry, I think the target was wrong. I think Tata Steel has potential to come in the range of 1300 to 1400 mark in next 3 to 6 months time. So on correction near to 975 to 900, you can buy Tata Steel with a stop loss of around 800, and your target would be in the range of 1300 to 1350.
Mm-hmm. Are you liking SAIL also, because it has nearly doubled in last 4 to 5 months?
Definitely, because if you're talking about a little bit long term, definitely you can take a chance in SAIL also, because SAIL has already given a breakout above 105, and the target of that breakout comes near to 150 to 160 mark. So on correction near 110, 105, you can buy SAIL also with the stop loss of 90 rupees.
Mr. Bagga, any two key factors that you will be watching out for a direction? I mean, that would have an impact, in the long term of investment into equity markets.
Yeah, I think biggest question one must keep on asking themselves is this dot-com too, or is this the roaring 20s? And if you get that right, if you're optimistic, I think like whoever was optimistic last year made a ton of money. Whoever sat on the sidelines, as most ultra HNIs did not really participate. So this kind of liquidity, people say it's foolish that you give a very simplistic analysis when you say it's liquidity, but you don't fight a wall of liquidity like this. That is one. But having said that, the second part is understand your risk. So there are a lot of new investors who have entered the market. Look at the returns of all the brokerages. So many new investors are coming. We had 100 trillion rupee volumes on the last expiry on April 29th. So volumes are exploding. Everybody overestimates their skills to make money in the markets. It's not easy. It's not easy. It is simple, but it needs a lot of discipline and it needs a lot of holding power to make money. So mostly 95 to 97% traders make losses in the markets. That's what global research has shown. And even the Indian brokers like Zerodha have taken out research which shows that. So don't overestimate your risk handling capacity. Be very diversified, stick with quality. And, it is a very over-leveraged world. It is a world awash in liquidity. It can change next year if inflation goes out of hand. Global central banks can start pulling the rope. So be ready for that. I think we have a 2 years to 5 year window of growth for the global economy. But it could be that this is March 2000 and the crash is imminent. Who knows? You should have enough powder at that time to take the crash and then reinvest and take quality stocks at the lower levels. So diversify, keep powder on the side, and don't overestimate your risk handling capacity.
Other than equities, Mr. Bagga, is there any other asset that one should really diversify into? I mean, is it proper to get into gold? Because we are talking about inflation, which and gold is a safe haven. Is considered like safe haven against inflation. So is it the right time to get into, partly into gold investment?
See, for Indian investors, we are already quite over-invested in gold in terms of the amount of gold we inherit within our families. Indians are holding nearly $1.5 trillion of gold at a household level. So 5%, 10% of portfolio can be looked at gold. Since August, it's underperformed like anything. It's fallen very sharply. So people have made losses. Big reasons for that is one, the central bank stopped buying. The Russians who were buying a big amount of gold stopped around August. We missed that completely, even though they broadcast it. Second, the Chinese and Indian consumers had stopped buying. Now that has returned. February, March was huge buying by the Chinese consumer, and the Indian consumer is also buying. Yesterday, you would have seen in the Titan commentary, the overall gold buying is returning by the consumers. Has Bitcoin, taken over the role of gold? I don't think so, because the kind of people who are speculating in Bitcoin were not the gold buyers as such. Or if you were a commodity player hedging your production of gold, you will not go and buy Bitcoin. Or Infosys is not buying Bitcoin, or it ever bought gold. So gold will give steady returns near to inflation. In a scenario where we are seeing inflation go up 1 year to 2 years down the road, I think it's a good idea. Overall, fundamentally, the drivers for gold are intact and they are improving from August last year to today. I think the drivers have improved. Manas can give a better idea on the technicals of it. But I think on a 1 year basis, you would make a pretty decent return on gold. Nothing like equities, but you would beat inflation.
Manas, if you track gold charts, what are charts saying?
Yeah, I think in last 6-8 months time, we have seen almost $400 correction in gold, and now in that gold has already made a bottom near to 1700, 1650 mark, and it has started making higher tops and higher bottoms. I believe that it will not go below 1650, and you can see the targets of around 2000 to 2050 in next 6 to 8 months time in gold. So definitely at current levels, I would like to recommend a buy in gold with stop loss of 1650 and target would be around 2100.
Mr. Bagga, what will you advise to investors who are sitting on the sidelines, still waiting for the correction to happen and enter the markets?
Only in retrospect we can know what was the bottom and what is the top. So, my advice could be totally wrong or it could be right. Who knows? So, I would say it's better to be invested rather than not to be invested. That's the first thing. Second, better to be diversified. The Warren Buffetts of the world can hold 10, 12 stocks and do very well. We cannot. Most of us cannot. Even the fund managers hold 40 stocks in their funds. They don't go with one. So don't bet the farm on one stock. So diversify. And third is stick with quality. We have seen momentum really overperforming. A very renowned value fund manager committed suicide day before. You would have seen in Manhattan. He jumped off a skyscraper. So value investors have underperformed for nearly 13 years. But the signals are value might be coming back. So only thing is there's so much liquidity that momentum continues to do well. So build a portfolio which is a barbell, have participation in the momentum for nearly 30-35% of your portfolio, and have the steady IDs, the quality portfolio for your 60 to 70%, which will hold up value across the cycle. And learn to invest through the cycle. The cycle will be inevitable. India, we are lucky that we have had 5-6 years of underperformance on economic growth. We have been very unfortunate with the disasters that we have faced. It will turn. The potential of the economy is very strong. We have missed it. I think around next February, March, you would finally be looking back and saying, yeah, this was also another good point. Economically, we will recover over 6 to 18 months. 6 months, we'll start seeing better times. And 18 months, it might be a roaring economy. That's my estimate. And then the elections come up in 2024. So then that becomes a sweet spot. 2023 budget will be a very blockbuster budget, and they'll do a lot to really unleash the animal spirits. So markets will start taking positions in 22 for looking at that.
Hope for the best. Thank you, Mr. Bagga and Mr. Jaiswal, for being with us. It was a pleasure speaking with you.
Thank you.